There's often a lot of talk about bear and bull markets. You've probably heard the terms thrown around quite a bit. And in this video, we're going to be specifically discussing what a bear market is and how it has historically impacted the financial markets. Let's get started. Defined simply, a bear market is when the financial markets experience a decline in both value and investor confidence over a period of time. A decline of 20% over that period is generally accepted as initiating a bear market sediment. Most worrisome for investors is that bear markets can often coincide with greater macroeconomic events such as recessions, which can have a detrimental impact on financial markets and on investor confidence overall. Investor mentality is an incredibly important thing to consider during a bear market because investors are going to be risk averse. They're not going to be willing to put their money into speculative assets. They're looking for safe places to store their money. They might even pull their money out of the market completely and move into a cash position in order to protect their finances. Compare this to a bull market where investors are likely to be kind of like risk seeking. They're going to be putting their money into growth stocks, looking to take advantage of that bull mentality of a bull market. They are very conflicting types of mentalities, and you need to be aware of it when entering a bear market. Alright, so what are some of the warning signs that can kind of tip us off to let us know that a bear market might be coming? Well, the first thing to identify is that these are just warning signs, and there's no real way to know for sure if a bear market's around the corner. It's one of the things about the stock market. You can't really predict what's going to happen the next day, although you can take some signals in order to kind of create a greater picture to help you make informed decisions. The first signal for a bear market is also one of the largest ones, and that is a struggling or weak economy. Factors like high unemployment, low productivity, or low profitability are things that can contribute to what is a weak economy and also a bear market. Secondly, government intervention like raising interest rates can have an immense impact on investor sentiment, ushering in a bear market mentality. Remember, the investor sentiment in the market is incredibly important. If investors are fearful and they sell off their stocks and their assets, what ultimately happens is the value of the market goes down. And as people see the value of the market going down, they become increasingly fearful and they start to sell off more and more of their assets, driving the bear market mentality even further, strengthening the fear that exists in a bear market. Bear markets can last for a varying amount of time. A cyclical bear market can last anywhere from several weeks to several months and was illustrated in March 11th, 2020 when the pandemic struck hold and hammered the markets. Although that particular bear market was relatively short-lived thanks to stimulus creating an absolutely incredible recovery, some bear markets can last for several years and even longer. Take, for instance, what are known as secular bear markets, which can last for decades as was experienced in the 1960s and 70s. Let's take a moment to discuss the terminology of bear and bull markets themselves. The term bear market and bear in general comes from the idea of what a bear does when it sees its prey. It slashes its thing down just like a bear will slash the price of a stock down. Bears are also lumbering, they're slow, and they tend to hibernate in the winter. That makes this image of like a bear sleeping in its den, very immobile and quiet. Those are the characteristics of a bear market. Conversely, a bull market is characterized by the bull's horns, which point upward, and also a bull rushes forward with incredible momentum, strength, and energy. Those are the things that are characteristic of a bull market. A ton of upward momentum. People buying stocks. People are energetic. They're exciting. It's the opposite of a bear market where people are sleepy. They're fearful. They're, in their dens just kind of sleeping away as the market tends to go down and down. A bull has rush. It has energy. It has momentum. Its horns are pointing up as a bear slashes things down. And those are the roots of those terminologies. With that being said, the term bear can be used to describe somebody who thinks that the market is going to underperform over a period of time. Someone can be bearish on the market as a whole. Someone can be bearish on a particular commodity, a particular sector, or a particular stock. For instance, you could be bearish on energy. You could be bearish on Exxon, a particular company within the energy sector. It all depends on, what is going on at the time and how your mentality is. You can also be a bull. Someone who's a bull thinks that the market is going to see an upward trend. You can be bullish on a particular sector. You can be bullish on a particular stock. You can think that that stock is going to ride itself to the moon, and that is what a bull believes, whereas a bear sees a pessimistic attitude towards the market overall. Thanks for watching, and if you'd like to learn more, definitely check out this playlist, which is like a video dictionary for all terms related to finance. Thanks for watching, and we'll see you in the next video.